Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Darden Restaurants Inc. quarterly report. Darden Restaurants Inc. operates a diverse range of full-service restaurants across the United States and Canada. The company's portfolio includes several well-known brands such as Olive Garden, Longhorn Steakhouse, Cheddar's Scratch Kitchen, and Yard House. Other notable brands under Darden's umbrella include Ruth's Chris Steakhouse, The Capitol Grill, Seasons 52, Eddie vs. Prime Seafood, Bahama Breeze, and Chai's. In addition to these prominent restaurant chains, Darden also operates under its own brand name, as well as the Capitol Burger. This extensive list of brands showcases the company's commitment to providing a wide variety of dining experiences for customers across different regions and cuisines. With over 80 years of history, Darden Restaurants, Inc. has established itself as a leading player in the full-service restaurant industry. Darden Restaurants, Inc. market capitalization of $23 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Darden Restaurants, Inc. holds a significant advantage in their industry. Darden Restaurants, Inc. trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 10.69 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 82% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 3.06%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted the company's sales over time. On the positive side, the acquisition of Chai's Holdings, Inc. has contributed significantly to revenue growth. Additionally, increases in same-restaurant sales and revenue from new restaurants have also driven growth. Furthermore, the addition of Chai's operating results has further boosted revenue. On the other hand, several factors have led to a decline in revenue. The expected permanent closure of approximately 14 Bahama Breeze restaurants will undoubtedly impact sales negatively. Higher food and beverage costs, restaurant expenses, labor costs, and staffing levels have also contributed to the decline in revenue. These factors highlight the importance of effective cost management and strategic planning in maintaining revenue growth. In summary, while there are several drivers of revenue growth, including acquisitions and same-restaurant sales increases, a number of factors have led to a decline in revenue, primarily related to costs and closures. The net income of a company underwent a mixed trend over the past year. Initially, it decreased by $16.6 million for the 3 months ended February 22, 2026 compared to the same period in 2025. However, this decline was followed by an increase of $56 million for the 9 months ended February 22, 2026. On a yearly basis, net income rose from $745.8 million in 2025 to $801.8 million in 2026, representing a 7.5% growth. In terms of profit margins, there was a slight decline observed during the 3-month period. The operating income margin decreased by 1.2%, while the net income margin dropped by 1.1%. Nevertheless, it is worth noting that profit margins remained relatively stable between the two periods, with no significant changes recorded. This suggests that despite some fluctuations in net income and profit margins, the overall trend was one of stability rather than decline. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. As evident from the data, the company has consistently produced positive operating cash flow over the past 2 years. In 2026, the operating cash flow stood at $1,009.2 million, which is more than sufficient to cover the current liabilities of $2,608.3 million. This trend is further reinforced by the net cash provided by operating activities, which has shown a steady increase from $1,250 million in 2025 to $1,281 million in 2026. The company's ability to generate such significant amounts of cash from its core operations is a testament to its financial health and stability. The positive operating cash flow is also reflected in the summary provided on page 38, which states that the net cash flows provided by operating activities for fiscal 2026 were $1.28 billion. This figure not only indicates a substantial increase in cash generation, but also underscores the company's ability to manage its finances effectively. Overall, the data suggests that the company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes in recent years. In terms of debt level, the data reveals a substantial increase in both long-term debt and total liabilities. Long-term debt has risen by $12.1 million, while total liabilities have surged by a staggering $509.1 million. This indicates that the company's financial obligations have grown substantially over time. On the other hand, interest expenses have decreased significantly. The company's interest expenses have dropped from $18.3 million to $8.6 million, representing a decline of $9.7 million. This reduction in interest expenses suggests that the company has managed to reduce its borrowing costs or renegotiate more favorable loan terms. Overall, these changes suggest that the company is grappling with increased financial obligations while also achieving cost savings through reduced interest expenses. Management is optimistic about the company's outlook for fiscal 2026. They are projecting sales growth of approximately 9.5%, with same-restaurant sales growth expected to reach around 4.5%. The company plans to expand its operations by opening approximately 70 new restaurants. In terms of financing, management believes that the company's internal cash-generating capabilities will be sufficient to cover capital expenditures, debt maturities, and other operating activities through fiscal 2026. Additionally, they are exploring alternative funding options, such as issuing equity or unsecured debt securities, or drawing on short-term commercial paper. The board of directors has also authorized a new share repurchase program, allowing the company to purchase up to $1 billion of outstanding common stock. This move is likely intended to boost shareholder value and demonstrate confidence in the company's future prospects. Overall, management's outlook suggests that the company is poised for continued growth and expansion. The company has made several strategic moves through acquisitions and divestitures to shape its portfolio. In terms of acquisitions, two notable examples are the purchase of Chai's, which is mentioned on pages 34 and 35 of the report. This acquisition suggests that the company is expanding its offerings in a specific market or segment. On the other hand, the company has also engaged in divestitures to streamline its operations and focus on core businesses. One significant example is the disposition of Red Lobster in fiscal 2015, which was likely done to free up resources for more strategic investments. Additionally, the sale of Olive Garden Canada restaurants during the first quarter of fiscal 2026 indicates a deliberate effort to exit non-core markets. Furthermore, the company has also closed underperforming locations to optimize its operations. For instance, it closed 15 Bahama Breeze locations in May 2025, which suggests that the company is willing to take tough decisions to improve profitability and competitiveness. Overall, these acquisitions and divestitures demonstrate a thoughtful approach to portfolio management and strategic growth. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has declared significant amounts, with $525.2 million being declared in total. This amount was then paid out to shareholders in the years 2025 and 2026, totaling $521.5 million and $494.6 million respectively. In addition to dividend payments, the company has also engaged in share buybacks, repurchasing common stock for a total of $531.5 million. Specifically, notable transactions include $-53 million in November 2024 and $-367.2 million in May 2024. These actions demonstrate the company's commitment to returning value to its shareholders through both dividend payments and share buybacks. There are valid concerns about inventory buildup and supply chain disruption. The potential exploration of strategic alternatives for the Bahama Breeze brand could have a ripple effect on supply chain operations, as mentioned on page 12. Furthermore, a facility fire in the distribution network resulted in product loss, which may be linked to supply chain disruption. The explicit mention on page 40 highlights the impacts of shortages, delays, or interruptions in the delivery of food and other products from third-party vendors and suppliers. This suggests that the company is vulnerable to disruptions in its supply chain, which could lead to inventory buildup if not managed properly. That concludes the financial summary for Darden Restaurants Inc. Feel free to comment below, and I will be happy to answer them when possible.